taking the conversation on the markets forward with Jigar Mistry, the co-founder of Buoyant Capital, now joining in. Jigar, good morning. Thank you for joining in. The market was anticipating a rate cut. It has got one. Now it moves on to the next bit. There have been a flurry of IPOs that have come in. There is this next big trigger that happens next week when a lot of these IPOs will see their lock-in period end. There are more IPOs that are opening next week as well. Do you believe that the market upside remains fairly capped because there are still a lot of lingering moving parts that are still there when it comes to the trade deals, the IPOs and so on?
Yes, good morning, Hormaz. Thank you for inviting me to your show. If you break it down in two parts, one is sort of what RBI did, and the other part is with regards to what happens with the flows. Then I would say, there are deeper issues that we need to examine. Now, what remains unsaid is the fact that RBI is almost net short about $60 to $65 billion on the NDF markets. In order to supplant the liquidity when that book comes on shore, you would have to deploy all the three variables at your hand, which is, supply OMOs, do variable rate swaps, and maybe cut CRR as well. That will be the last resort. So whereas this is in line, we must not forget the fact that your current account was at 1.3% this time around. Your BOP was negative, which is the first in many quarters and years. And therefore, it is sort of, whereas we are celebrating the fact that the rates have been cut, from a wider standpoint, the heavy hand of the RBI is not maybe lost on everybody else. Secondly, with regards to flows, in fact, the flurry of, follow-on offerings or IPOs is a relief, so to speak, because if you take CY24 and 25 combined, then, all the so-called smart money has exited, or rather sold. Exited is the wrong word, maybe. FIs have sold about $38 billion, those 2 years combined. Companies have raised about $38 billion, and promoters through block deals and IPO OFS have sold about $44 billion. And the singular buyer for that has been $120 billion of domestic flows. Now, as we speak this, only 5.6% of the household savings is coming into equities. Most developed markets are upwards of 20%. US is upwards of 40%. And even if you pencil in, say, something like 10% of household saving coming to equities, in a couple of years, we are talking about $120, $150 billion sort of flows coming to equity markets in a singular year. If some of these IPOs manage to raise the money and suck some liquidity out, then that becomes a welcome relief rather than, something that evens out the scale. So we are happy that, something is coming and taking that liquidity out. Otherwise, the valuation of the entire market tends to get extremely elevated, as we saw in September 2024.
Jigar, if we can quickly tell us, before we talk about the visuals that we are getting, where Prime Minister Modi has reached the Rashtrapati Bhavan and Russian President Vladimir Putin is expected to arrive shortly. We'll keep discussing and understanding what's happening there. We do have Commerce Minister Piyush Goyal in the frame as well. And there are, of course, conversations going on the bilateral trade, a lot of other aspects of business as well. So we'll keep discussing that and getting you all the updates. Jigar, you spoke about how there are a lot of promoters selling stake, raising funds, a lot of PE exits as well. The other point that we have seen is that a lot of IPO proceeds, they're not going into capex, they're not going into corporate purposes, but it is largely offer for sale. Do you think that is something which is concerning?
Yes, Sonam. So if you take it to an extreme, right, you assume that the promoter shareholding is possibly at the lowest end of the spectrum that we have seen. And if incrementally the capex is not rising, as in the companies are not raising money to spend more, taken to an extreme, you're talking about a complete lack of entrepreneurs and an increasing spectrum of investors, which is not sort of good for the country over a longer period of time. And that is in consonance with the experience that we also have. The number of family offices in India is on the way up. And a large part of the second generation is keen on setting up family offices rather than, doing a lot of manufacturing activity themselves. Now, in light of this, you track it back and say that the private capex intensity to GDP will not keep pace, because prior to, I would say, 2015, when IBC was not there, when the asset quality review was not as staunch, you had a lot of evergreening come through. And since then, companies are being taken away from promoters. A few of them had to go to jail. And therefore, I think that free optionality that many of them enjoyed is no longer really available at the moment. So I would say that, we would not budget the capex intensity to remain as high. And therefore, overall capex, governments or private corporations, including, will not see the same intensity. In absolute number terms, they are rising, no doubt, across all spectrums. But the percentage to GDP, we should budget slightly lower.
To play devil's advocate here, Jigar, the fact that a lot of the promoter stakes are coming down, it's also the sign of a market which is maturing, right? Because in India, so far, these companies have been promoter controlled. In the US, you have some of the biggest companies, the promoters, you don't even know who they are. The founders will hold more often than not less than 1% stakes. So it is truly a shareholder-driven organization out there. And with the kind of democratization that we're seeing in the stock markets, increased demand for paper, it's only fair that someone supplies. In this case, it's the promoters. In the IPO case, it is the PE firms. The question then is growth and value. At what rate the companies are growing, and at what rate and at what valuation is the paper offered, irrespective of who's offering the paper or where that money is going, right? So when you look at just the growth and the valuation metric, what is it that stands out in terms of an investable idea for you?
Absolutely, Mangalam. So you correctly pointed out that we are still at 49.6% promoter holding. In the West, those numbers are way lower, and therefore the trajectory we are all building through is, toward the lower end, or at least that number falling, and obviously professional investors and retail taking up a large part of that. In terms of the second part of your question as to where we see value, by September 2024, and before I go there, if you take the 5 or a 10-year rolling return average on EPS and share price growth across different indices, those almost always align. Large cap index, small cap indices, or companies with a long enough trading history. By September 2024, you had a wide dislocation emerge in the small cap space. And since that corrected, by February, we saw a reasonably good balance emerge. There was still the indices were still ahead of the earnings growth, but there was some semblance of equilibrium getting established. Since then, however, the earnings have not really kept pace, right? First quarter on a very arguably a lower base, April, May, June 24 was a peak election season. And on that base, if we grew at 7%, 2Q on paper in headline numbers looks better at about 13% EBITDA growth, but this is all driven by cyclicals, so metals and mining, oil and gas, and that is prompting consensus to now reevaluate its earnings forecasts. For the first time since COVID, we are seeing the start of the forecast at a much higher number compared to as the year progresses. So, Nifty estimates have been cut for the first time since 2021. And 26 and 27, both earnings are cut. Within the spectrum, I think mid-cap is holding out fairly well, but mid-cap is a wide gamut, right? The largest mid-cap is about 104,000 crores in market cap. The smallest mid-cap is around 34,000 crores. So you're arguably talking $4 to $12 billion in market cap. And it is still, in our opinion, a lot more sector specific. Within the sectors on offer within that space, something like a consumption discretionary, not staples, is appealing to us. Travel leisure is appealing to us. Cement we see as a consumption play. And pharmaceuticals, for different reason, is also very interesting.
Right. So just before we let you go, Jigar, there's one final question from my end. You mentioned consumer discretionary. Does travel and tourism also feature in that? Because you're seeing what's happening right now with the aviation. You're seeing Indigo with brokerages being optimistic, being the largest airline, so on and so forth. But one systemic error and the entire system has collapsed. What do you do in, if you can comment specifically on Indigo and of course on the entire travel and tourism sector, if there are any proxies to play that, be it hotels, be it railways and so on?
Right, Roma. So stock specific is a bit of an issue to get into, but I would say, see, these issues create opportunities rather than, these are not systemic issues. Every now and again, given how fragile systems are, they will break down. But unless it points to something where, your demand is not picking up with supplies, etc., then that is a cause for concern. Other than that, we are in this space where, almost 1.7% of GDP, and we calculated some 6 lakh crores has moved into the hands of people, either via the states giving out more, for the lack of a better word, freebies, and government reducing income tax and GST. So that will eventually find its way into consumption, even if part of that is saved. And it's a great time to sort of accumulate some of those names.
All right, we take that point. Thank you so much, Jigar, for joining in and giving us your views on a whole host of ideas, and perhaps saying that, some of these disruptions in the travel and tourism space currently could be opportunities to buy. We'll obviously monitor all of these situations as they go along. With that, we'll take a short break. On the other side,